Welcome back to the deep dive. You're tuning in because, well, you want clarity, right? Especially when it comes to financial stuff that can actually, make a difference for your family. And today we're peeling back the layers on a really fascinating one. But hang on, really important note we always have to make.
Absolutely crucial.
Everything we talk about here, it's just for general info. This is
Right.
not tax advice. Everyone's situation is
It's
different.
personal, yeah.
So please, you absolutely need to consult a qualified tax or financial pro for guidance that's tailored just for you. Think of this deep dive as your starting point.
Your well-researched starting point, exactly, not the final answer.
So today, we're unwrapping a financial tool that's surprisingly flexible, often overlooked, maybe, and pretty powerful if you're looking to give a child a real financial leg up. We're talking about the UTMA account. That stands for Uniform Transfers to Minors Act.
All right.
Maybe you've thought about setting something up for a grandchild, a niece, nephew, your own kid, but you worry about taxes or, how much control they'll have later. This is your shortcut to understanding this specific thing.
Cutting through the jargon.
Exactly. Get straight to what matters.
That's the plan. Our mission today is, well, to really unpack what a UTMA is, how it actually works day to day, and really highlight its flexibility. Because it is surprisingly flexible compared to other ways you might save for a minor. And we'll definitely spend some good time on a pretty interesting tax strategy. It involves appreciated stocks.
Why?
And this thing called the kitty tax, we're aiming for those, aha moments where it clicks.
Okay, love those. So let's unpack it then. UTMA sounds kind of formal, Uniform Transfers to Minors Act. In plain English, what exactly is it? What does it mean for someone listening?
Okay, simplest terms. A UTMA is a type of custodial account. That just means an adult could be a parent, grandparent, aunt, uncle, really any adult can transfer assets to someone who's still a minor. And assets here is pretty broad. We're talking cash, stocks, bonds, mutual funds, sometimes even real estate or art, depending on the state.
Okay.
The key is an adult acts as the custodian. They manage these assets for the child until the child hits a certain age.
The age of majority.
Exactly. Usually 18 or 21. It really depends on the specific state where you set up the account. So it's basically a way to gift assets without needing a complex trust, but still keeping adult oversight for a while.
That makes sense. Practical, kind of simplified. And here's where I think a common misconception comes in. Our sources really hit this. You hear account for a child and you think,
College.
right, college savings,
Yeah.
like a 529 plan. But you mentioned broad applicability. UTMAs aren't just for college, are they?
No, absolutely not. And that's honestly one of its biggest strengths, this flexibility. It's often underappreciated. Sure, college is a totally valid use, very common. But the money isn't legally locked into that like, say, a 529 is. With those, you can get penalties if you don't use it for qualified education costs.
Right.
With a UTMA, the rule is pretty simple. The funds can be used for any expense that benefits the child. That's the key phrase.
Benefits the child.
Yeah. The custodian decides what that means, but it's remarkably broad.
That versatility is really something. And the sources we looked at, they give some great real-world examples, makes it concrete, Think about it. The money isn't just parked for some future tuition bill. Maybe it pays for, like, a special summer camp or music lessons.
Totally. Or helps buy their first car at 16.
Yeah. Or private school tuition, medical bills, a laptop for school, or even, like, travel that helps them learn. It's just so wide-ranging.
It really is. That broad use makes UTMAs pretty unique among accounts for minors. Much more versatile than many other options. Gives the custodian a lot of freedom.
Okay, and that freedom, that leads us to, well, one of the really interesting strategies, the tax angle.
Exactly. This is where it gets fascinating for some people. Donating highly appreciated stocks. Picture this. You bought some stock, maybe years ago, for $10 a share. Now it's worth $100 a share. Huge gain, right?
That's a problem to have.
Yeah. But if you sell it personally, you're looking at capital gains tax on that $90 profit per share, especially if you're in a higher tax bracket. That could be a big tax bite.
Okay, and here's where the UTMA trick comes in, right? This is the really interesting part for your bottom line. Instead of you selling that stock, you transfer the shares into the UTMA for the child. Then the custodian, maybe it's still you, acting as custodian, sells the stock from within the UTMA.
Yeah, it's the move.
And the magic is the capital gains are taxed at the child's tax rate, not yours.
Precisely. And that's where the kitty tax rules come into play. It's why this strategy can work so well, potentially turning a big tax bill into a small one, or maybe even zero.
Okay, kitty tax. Sounds a bit funny, but it's serious IRS stuff. What exactly is it? How does it work?
Yeah, it's just the IRS name for the rules about how a child's unearned income gets taxed. Yeah. Unearned income means things like interest, dividends, and yep, capital gains from selling stocks. The good news is the IRS lets kids have some unearned income taxed at their own rate, which is usually much lower than their parents.
Why is that?
Well, the idea is partly to let kids maybe earn a little interest or receive small gifts without getting hit by their parents' higher tax rates. But the IRS also doesn't want wealthy parents just funneling all their investment income through their kids' accounts to dodge taxes.
Ah, closing a loophole.
Basically. So they set up these specific tiers, these thresholds. Now, for 2025, the numbers are pretty clear. The first $1,250 of a child's unearned income, completely tax-free, zero federal income tax.
Wow. Okay. $1,250 free and clear.
Right. Then, the next $1,250 is taxed, but at the child's rate, often just 10%. Super low for most kids.
Okay, so that's $2,500 total. That's either tax-free or taxed really low.
Exactly. But here's the catch. Any unearned income above that $2,500 threshold, that gets taxed at the parent's marginal tax rate.
Okay, so you can't just shift unlimited amount.
No way. But with careful planning, you could potentially sell some appreciated stock each year, realize gains up to that $2,500 limit, and pay very little, maybe even zero federal tax on it. Of course, and this is critical, you always need to check the current IRS rules. These numbers change. They get adjusted for inflation. Sometimes rules change. So stay updated.
And that really is the aha moment, isn't it? For certain families, certain investors, the potential tax savings could be huge, especially if you're holding assets with big gains, things you've held a long time. If you're in, say, the 20% capital gains bracket, selling stock with a $10,000 gain yourself costs you, what, $2,000 in tax?
Certainly, yeah.
But if you transfer that stock to a UTMA, sell it strategically over maybe 4 years using the kiddie tax limit.
You might pay just a few $100s total, or maybe nothing, depending on other income.
That's a massive difference. It shows that UTMA isn't just like a piggy bank. It can be a really smart strategic move in the right situation. Okay, so the tax savings angle is definitely compelling. Paints a pretty attractive picture. But like any financial tool that sounds this good, there's always a flip side, right? A trade-off.
Oh, yes.
It's super important to look at both sides, the pros and the cons. So let's quickly run through those based on our sources. What should you be weighing up?
Okay, on the pros side, number one is definitely that flexibility we talked about. Use the money for almost anything benefiting the child, way beyond just college. Big plus.
Right.
Then the potential tax savings, especially with those appreciated assets and the kiddie tax play. That can be a real win for wealth transfer. And third, they're generally easy to set up. You don't usually need lawyers and complex documents.
Whoa.
Most banks, brokerages, they offer UTMAs. Relatively simple process. But the cons, and these are really important, can be deal breakers for some. First, gifts into a UTMA are irrevocable. This is huge. Once you put assets in, they belong to the child. Legally, you cannot take them back, ever, even if your circumstances change dramatically.
Wow, that's permanent.
It is. You lose control over that specific asset. Second, UTMA assets can impact college financial aid, maybe significantly.
How so?
For financial aid formulas, like the FSA, assets in a UTMA are counted as the student's assets. And student assets reduce aid eligibility much more heavily than parent assets do. That's something to really consider if you expect to need need-based aid.
That's a critical point for college planning.
Okay.
And maybe the biggest one, the one that gives parents the most pause.
Yeah, I think so. It's that once the child reaches that age of majority, again, 18 or 21, depending on the state, they get full unrestricted control of the account.
No strings attached.
Absolutely none. They can take all the money out and do whatever they want with it. Buy a car, travel the world, invest it wisely, or, blow it all in Vegas.
Yikes. Okay. That definitely raises a big question for anyone listening, doesn't it? So thinking about all this, what does it mean for you, for your family's long-term financial plan? How do you weigh that flexibility and potential tax saving against the irrevocability and that final transfer of control? It's powerful, but yeah, needs careful thought.
Right. To sum it up, UTMAs, they can be a really effective way to pass on wealth, potentially save quite a bit on taxes, and maybe even start teaching kids about money, about responsibility, which is huge. But like we said, definitely not one size fits all. It really depends on your specific finances, your goals for the child, and honestly, your comfort level. How comfortable are you with giving away that asset permanently, and with that young adult eventually getting total control? Great benefits, but real trade-offs.